Hello again and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is May 20th, 2021. Let's get to our updates of the day. Thanks for watching. Let's discuss the big three today that we're paying attention to here at Blanke Schein Wealth Management. We believe it's relevant and market moving items that we need to discuss. We're watching it, so you should be too. And let's talk about it. Number one is the bottlenecks that are happening across the United States supply chain in all facets of sort of the U.S. economy right now. And that's obviously a result to you can't turn off like we did last year, the U.S. economy, and just turn it back on. The U.S. economy does not work like a light switch. And so we're seeing the natural progression of turning on, opening back up across the United States. And so it's going to take some time to get inventories and products and goods and services back to where they need to be to meet up the pent-up demand and the excess cash in the money supply. We talked about this. It's up 27% cash in the banks on hand in the U.S. consumer and corporation. So that cash, again, Milton Friedman once said that the definition of inflation is too many dollars chasing after too few goods and services. Now that's created the transitory conversation that the Federal Reserve is sticking to as it relates to the bottlenecks, or this moment in time of turning the economy back on, is only causing a transitory or temporary translation to that word, an inflation. So the Federal Reserve sees that inflation is transitory, and therefore their policy statement at FMOC meeting released their minutes yesterday. And they also indicate that there are some members of the committee that are looking towards the back half of 2021 to say, wait a minute, even though we believe that inflation will work its way through and it's only temporary as we see inflation surges everywhere, that actually once that works its way through the U.S. economy and we get sort of equilibrium, then we will see the real true demand of the U.S. economy. At that moment in time, they could take an honest appraisal of whether or not they should raise interest rates or reduce the accommodations, some form of a combination of both. What that really means, and we've seen this back in the most recent history, it's called the temper tantrum of what the tape does or what the yields do. Yield curve basically is really, by the 10-year treasury, really starts rising or starts getting upset, and markets start selling off when the Federal Reserve starts taking away the accommodations. Now think of it this way. It's a lot of sort of economic 101 conversation here, but the best way to think about it is, let's say you're in the hospital, you had a surgery, and now you're, first, year, let's say the U.S. economy was under intensive care, and now you get moved to just the normal care of the hospital, a different section of the hospital, but you're still not out of the hospital yet. That's where the U.S. economy is right now with regards to the U.S. Sort of the Federal Reserve providing a backdrop to the U.S. economy. Again, you're still in the hospital, you're wearing off of the surgery, you're now feeling some pains associated with the post-op, and now you're still receiving pain meds. Now, what this really means is that when you get officially out of the hospital and you go home, you're now dealing with a whole new subset of reality. And the pain meds, right? The doctors want you to sort of wean you off of that because it's not good long term. The pain meds are the sugar high that the accommodation is being provided, because then the body then, once you're out there outside the hospital trying to make it a go, you're really feeling the net negative effects of that post-surgery. Your body's sort of healing with that, and taking away that accommodation or those pain meds, your body is going to have some substantial challenges. That's where we are going to see the U.S. economy on a go-forward basis. When the patient, i.e. U.S. economy, is officially out of the hospital and has to then work its way through no more accommodations, or the removal of the accommodations, i.e. the medicine in this case, for this analogy. So that's what we're going to be paying close attention to. And also the U.S. housing market is continuing to be super hot. Why? Well, it's also an inflation hedge, right? Real estate is an inflation hedge. And we have a lot more demand than we have supply. We're about 4 million units undersupplied in the U.S. economy right now. And keep in mind, back in 2007, 2008, when we had the housing crisis, boom and bust, that really stopped the production of housing and new housing starts. So when we shut off supply even a decade ago and we don't build as many because demand wasn't there, and then we turn on demand because of interest rates are so low, because people can work from anywhere, and people are now bringing in another generation of buyers, and millennials are now saying, wait a minute, I don't need to rent anymore. I have enough money, let's go buy a house. you have a net negative in terms of supply on the market right now, with all of that to be considered. Also, we're about a 2.5 month supply on the market, where the average is 4 months. So we are going to still see this housing continue to be strong, even though mortgage rates have sort of moderated and mortgage demand is moderated in terms of the refi. But interest rates long-term, from a long-term perspective, are still historically low. So you're still going to get a good deal. If you lock in an interest rate now and you even buy a house, it's an inflation hedge over time, and that debt remains the same. So your house value goes up over time, and the debt that you have with the bank, i.e. your mortgage, remains the same. So inflation will help you pay it off as your income grows, as your assets grow over time. So inflation is the number one liquidator of all debt. And that's important to know, because that's what's playing out right now as we see all around us. So lock in your interest rate as long as you can, and get it as low as you can, because over time we will see all of our assets rise, because we're in an inflationary environment. At least that's what the market's telling us right now, and that's what we're seeing on a day-to-day basis. Even if you go to the grocery store, you're seeing it to yourself. So that's our update today. We talked about the Federal Reserve. We're going to continue to talk about Federal Reserve. They did have some language that they did change a little bit, and they said substantial further progress needs to be made in the U.S. economy. So in the short term, we believe that they're going to be still accommodative, but we're going to watch their language. So when they release the minutes or the post, let's say meeting later this summer, when they have meetings, the interview with the Federal Reserve Chairman Jerome Powell, those are going to be very impactful to the market, and those are going to move markets, and we're going to pay attention to it closely. So right now, market is, so the U.S. economy is moving in the right direction on all cylinders, and that's a good thing. So thanks for watching Blanke Schein Wealth Management for our updates, and we'll see you again next time.